The RDW cash flow trap thesis just got its biggest test, and here is my honest opinion. I am more bullish on Redwire, the business, than I was before, but I'm also more focused on dilution than I was before. That sounds contradictory. It is not. Redwire is not raising money into an empty story. It is raising money into revenue growth, backlog, defense demand, space infrastructure, autonomous systems, and microgravity optionality. The question is no longer whether Redwire is real. I think the question has been answered. The real question is whether common shareholders will benefit from the company becoming more real. That is the $500 million dilution test. Here is where my view changed. In the first video, I treated RDW mainly as a cash flow trap risk. After the new data, I still see that risk, but I also think the market may be too quick to treat this dilution as weakness. If this capital is being used to scale a real space defense platform, the ATM could be painful in the short term, but strategically useful long term. Redwire filed for a new at-the-market offering of up to $500 million after already selling about $350 million under the prior equity program. That does not mean all $500 million has been sold, but it does mean every RDW bull now has to track the share count, not just the story. A cash flow trap is when the company story keeps improving, but the shareholder math does not. Revenue grows, backlog grows, product announcements keep coming. The business sounds more strategic every month, but free cash flow stays negative and the share count keeps rising. That is the trap. But a cash flow trap becomes dangerous when capital only buys more time. It becomes interesting when capital buys scale. That is why I am not treating this ATM as automatic bad news. I am treating it as the moment Redwire has to prove this is offensive capital, not survival capital. In the first Redwire deep dive, I broke down what Redwire actually is, why it is not just a space stock, why edge autonomy changed the business, how the backlog works, and why the whole thesis comes down to one question. Can Redwire turn contracts into revenue, revenue into margin, and margin into free cash flow before dilution takes too much of the upside? If you want the full company primer, watch that previous deep dive after this video. But the story did not freeze after that video. The new data makes the Redwire setup more interesting, more measurable, and higher stakes. And if you own this stock or you are thinking about chasing it after a move, this is the part of the story you cannot skip. My updated view is simple. RDW is a high-risk transition story where dilution may be funding the move from space hype to a larger space defense operating platform. I lean bullish on the business. I am more demanding on the stock. And from here, the stock lives or dies by per share value. That is the real follow-up. Now let us start with the headline that matters. On June 9th, Redwire filed a prospectus supplement for an at-the-market offering of up to $500 million of common stock. That means the company may sell common shares from time to time through its agents. This is not the same thing as saying the entire $500 million has already been sold, but it is still a very important filing, because the same filing says that before this new supplement, Redwire had already sold about $350 million of common stock under its May 2026 equity distribution agreement. That is the part a lot of people will miss. The story is not only Redwire has a new ATM. The story is Redwire already used a major ATM, then opened another major ATM. And that changes the way I frame the stock. I do not automatically hate that. A growing aerospace and defense platform needs capital. Edge autonomy was a major acquisition. Redwire has defense production ambitions. It has space infrastructure ambitions. It has microgravity and biotech ambitions. It has debt integration costs, working capital needs, and research and development needs. The bearish mistake is assuming dilution means the business is weak. I think that is too simple. Redwire is not raising into a dead story. It is raising into demand, backlog, defense optionality, and a business that may finally have enough scale to matter. If the company can raise capital while the market is willing to fund it and then turn that capital into higher revenue, stronger margins, and durable free cash flow, then dilution can be the price of building something larger. But if the company raises capital and the operating proof does not follow, then dilution becomes the product. That is the line. Offensive capital creates per share value. Survival capital only extends the story. The June filing also gives us a clean way to explain the math. Redwire said it had about 238.8 million shares outstanding as of June 8th. The filing showed a hypothetical after-offering share count of up to about 265.8 million shares, assuming shares were sold at $18.57. The filing is clear that the actual number of shares depends on the price where shares are sold. So do not treat that as a fixed share count. Treat it as the warning label. When stock is sold at higher prices, the company can raise more dollars per share issued. When stock is sold at lower prices, the same dollar target requires more shares. That is the simple dilution visual. Higher stock price, same dollars raised, fewer shares issued. Lower stock price, same dollars raised, more shares issued. Very low stock price, same dollars raised, painful dilution. Imagine Redwire needs to raise the same amount of money. If the stock price is high, it sells fewer slices of the company. If the stock price is low, it has to sell more slices. That is why the ATM is not just about raising cash. It is about what price the company raises at. That is why the stock price matters so much after an ATM filing, not because a daily chart is the thesis, but because the stock price affects the per share cost of funding the company. As of the latest market refresh, I checked before this script, Redwire was around $10.93 with very heavy volume. Refresh that number before recording because the exact quote will change. But the concept will not change. If the market lets Redwire raise money at strong prices, shareholders can tolerate some dilution more easily. If the market reprices the stock lower while the ATM remains open, the dilution math becomes more painful. This is why I do not want viewers thinking in slogans. Bull case, capital funds scale. Bear case, capital funds time. My view, RDW has enough real demand that I am not calling this survival capital yet. So the next financial update has to be judged through a very specific lens. Per share value, did the company grow the operating engine faster than it grew the share count? That is the test. This is where I lean more bullish than the market panic. I do not love dilution. Nobody should. But I care more about what the dilution is funding. If Redwire were raising money with no backlog, no revenue growth, no strategic assets, and no real customer demand, I would hate this setup. That is not the situation. In Q1 2026, Redwire reported $97 million of revenue, up 57.9% year over year. Gross margin improved to 26.6%. Contracted backlog reached $498.1 million. Book-to-bill was 1.92. And management reaffirmed a 2026 revenue forecast of $450 million to $500 million. That does not prove free cash flow yet. But it does prove this is not just a concept stock begging the market for survival capital. This may be offensive capital. The reason I am not dismissing RDW is because this is not just another small space company selling one cool product. Redwire is trying to become a two-engine platform. One engine is space infrastructure, power, structures, sensors, payloads, and microgravity systems. The other engine is defense autonomy, uncrewed aircraft systems, ISR payloads, and allied defense demand. If those two engines start feeding each other, the market may eventually stop valuing RDW like a speculative space stock and start valuing it like a niche space defense platform. That transition can work. but can work and has worked for common shareholders are not the same sentence. The Q1 report showed the tension perfectly. Revenue was growing, backlog was strong, liquidity was higher, but adjusted EBITDA was still negative $9.2 million. Free cash flow was still negative. The net loss was large, even though management identified more than $44 million of non-recurring activity tied mainly to Edge Autonomy Incentive Unit compensation acceleration. So yes, there are adjustments, but investors cannot pay bills with adjusted explanations. At some point, the receipts have to show up in operating cash flow and free cash flow. That is why this is now a scorecard, not a vibes trade. The company has less room to tell a vague story. It has to show conversion. Now let us talk about the new positive data point, because there was one. On June 18th, Redwire said it completed on-orbit operations for a batch of pharmaceutical and biotech investigations that returned to Earth on June 17th. The partners included Aspera Biomedicines, Bristol Myers Squibb, Rowan University, Purdue University, and researchers from the University of Alabama at Birmingham. Redwire said these latest investigations marked 54 PIL boxes flown to date. This matters, but it needs to be framed correctly. This is not why I would buy or avoid RDW today. But it matters because it shows Redwire has real technical optionality beyond standard space hardware. The mistake would be treating it like near-term cash flow. The opportunity is treating it like long-term platform value. If you are bullish, you want more of these operating updates because they show Redwire has real technical assets. If you are disciplined, you still ask how much revenue, what margin, how repeatable, how much cash conversion. Now there is one more recent filing that I would not make the center of the video, but I would not ignore either. On June 18th, Redwire filed an 8K saying a court issued preliminary approval of a proposed settlement of shareholder derivative claims. The settlement calls for corporate governance reforms. Redwire said attorneys' fees and expenses are expected to be funded by its insurance carrier. And the final approval hearing is set for July 30th, 2026. This is a footnote, not the emotional center of the story, but it belongs in the risk framework because the ATM prospectus also references internal control weakness language from its audit context. For a small public company trying to integrate acquisitions, raise capital, sell into government and defense markets, and build credibility with investors, controls matter. Governance matters. Disclosure quality matters. And that is why I would not hand-wave the filing away. If the bull case is Redwire can become a higher quality defense and space platform, then the company has to behave like a higher quality defense and space platform. That means stronger controls, cleaner reporting, better conversion from backlog to cash, more visibility into share count, and less dependence on investors simply believing the story. So where does that leave us? The bar is higher now. The story has graduated from interesting to prove it like shaksh. Here is my RDW scorecard. 1. Share count. How much more stock has actually been sold at what average price? How much cash did Redwire raise? And what does the new share count look like? This is not optional. If you own the stock, you need to track it because the denominator matters. 2, backlog conversion. Backlog was $498.1 million in Q1. Book-to-bill was 1.92. That is a strong demand signal, but backlog is not cash. If backlog grows and revenue grows while margins improve, that is bullish. If backlog looks good, but revenue conversion, working capital, or margins disappoint, then the story weakens. 3, cash flow. This is the big one. Revenue growth is not enough. Adjusted EBITDA is not enough. Contract wins are not enough. The market needs evidence that the business is moving towards self-funding. That means operating cash flow improving, free cash flow improving, and losses becoming less dependent on adjustments. If Redwire shows that, the follow-up to this follow-up can become much more constructive. If it does not, then the ATM filing becomes the center of the story. And I do not want the ATM to be the center of the story. I want the products to be the center. I want the backlog to be the center. I want the defense tech segment to be the center. I want microgravity pharma and space infrastructure to be the center. But the company has to earn that by showing that the financial engine can support the ambition. So my view is simple. RDW is not a dead cash flow trap. It is a dilution test with a real business underneath it. If this capital turns into scale, margin, and cash flow, the bulls may be right. If it only turns into more shares, the trap wins. That is my line. I am more bullish on the business. I am more demanding on the stock. And the next quarter matters more than the last viral video. If you want the full background on what Redwire sells, who pays them, how Edge Autonomy changed the company, and why the backlog matters, watch the previous Redwire deep dive first. The previous video explained the machine. This one explains what the machine has to prove now. And the next filing will tell us whether this is offensive capital building scale or survival capital keeping the story alive. As always, this is educational research only. It is not financial advice. It is not a buy, sell, or hold recommendation. Do your own work, read the filings, track the share count, and never let a good story replace the receipts.